As I just talked to Lillian, I'm trying to pick up what we left yesterday regarding the chapter 6, the CVP analysis. So yesterday we went over the comparison of the traditional income statement and the contribution margin income statement. The contribution income statement is the main format of the tool we used for Chapter 6 and Chapter 7 and some of the future materials for internal analysis and decision making. So I really truly want everyone, you have a good understanding and master how to apply the structure of the contribution margin income statement to help you solve different problems. So a quick review from what we had yesterday. And this is the current contribution margin income statement for the example used in the book. For the bicycle company, when you try to solve a problem from the homework, normally they give you a current condition. So the operational situation for the, like you have a sales volume, pricing, and cost information. So we have the bicycles here, the current sales volume, 500 bicycles. And then I'm not presenting here, but in the book, they let you know the total variable expense, including, I didn't have that, but the slide we went over yesterday, I think I probably can make this. Yeah, give me a second. So. Because I put the name on the left, so it's cut off when I try to copy and paste the slide. But quickly inside the variable expense, I want to make sure if you take notes, you make sure you understand what are the items included under the variable expenses. We have the variable manufacture cost and the variable period cost. Under the variable manufacture cost, we have direct material, direct labor, and variable overhead. Sometimes people forget the direct material and the direct labor because they are always variable costs. So we don't really call a variable direct material or variable direct labor because you know the assumption is already they are variable. So those three variable manufacture costs, then we have the variable selling and variable admin expenses. So together you have 300 variable cost per unit. So the contribution margin income statement is after we use the sales revenue minus the total variable expense, you got the contribution margin. So this is the key concept, which is different from the gross margin we used in the traditional income statement. Gross margin is sales revenue minus cost of goods sold, okay, the total manufacture cost related to the sold units. So contribution margin, we have three ways to present and understand. You can calculate the total contribution margin based upon the current sales volume, or you can check for the contribution margin per unit. And the per unit information and the percentage information won't change with the sales volume unless you revise the pricing or the variable cost. Okay, so if you don't change the pricing, don't change the variable cost, the per unit and the percentage column will stay the same. So contribution margin, that means before we cover all of the fixed expenses, how much margin earned by selling the products. Then the fixed expenses is a stable item, right, by the nature of the cost behavior. So for fixed expense, we don't have the per unit column and percentage because they are not related to the change of the volume of the units. So you present it as a total number on the first column. So $80,000 in our case. Again, make sure you understand what are the detailed items under fixed expense. Normally, we have 3 items for manufacturer companies. You have fixed overhead, fixed manufacturer overhead, then fixed selling expense, and fixed element, okay, like the groups. So we have 80,000 here for the bicycle company, so that will leave us a net operating income 20,000. That's your current situation. So based upon our understanding from here, we developed the 2 formulas, or you can say maybe 4 formulas to find out the break-even point and the target profit, sales volume or sales dollars. So I'm not really going into the details, but this is the result related to the example we are working on. For break-even formula, we went over this, and actually we developed the formula by our own approach rather than just memorize it. Break-even means the contribution margin just enough to cover your total fixed expense. So if I can put, so what means by break-even point? Okay, or a explanation by your words. The break-even point is basically at that point of sales, the contribution margin equals to the total fixed expense or fixed cost. Okay, I will put that here. So CM, contribution margin total equals to the fixed cost. So that's we can derive this formula. The sales units to break even for a company, you use the fixed expense total divided by the contribution margin per unit, because the total contribution margin is per unit times the break-even units. So for the bicycle case, we got 400. We also proved this using the worksheets yesterday. And if you want to find out the break-even in sales dollars, like the sales revenue of break-even directly, so we can change the unit contribution margin to the ratio. Okay, I'm not paste that, separate the formula because it's like a derived. So if you in the bottom, you use a contribution margin ratio, and this one will become the sales dollars. So break-even points in sales units or sales dollars. Then moving forward, no single company is happy with break-even only, right? So you are looking for some sort of profit or earnings. In that case, so if we have a target profit analysis, so means above break-even, we want to make some profit. In that case, we revise the formula, and that's why we add the target profit. So in the target profit means the contribution margin. After the contribution margin total cover the fixed expense, you still have some profit left. So that's the way we start working on the formula. So after you move the fixed expense on the right, you can see that's basically. So a slightly different, the only difference between the target profit formula as a break even is we add the fixed expense, add the target profit. Okay, whatever your desired amount of target profit. And if it's a units, you divide by the CM per unit, all dollars we use a ratio. And understandably, the target profit sales will be much higher than the break even. So in our case, if you want to earn a $100,000 profit, you have to double your sales, like more than double. So 400 break even and 900 is to reach this $100 targeted profit. So that's kind of a review for like the initial parts of chapter 6. And then I will use a homework practice to check about. And this one, the homework example is already posted on the Blackboard. And this is number 2, a comprehensive question regarding the CVP analysis. And the initial question, you have 4 problems regarding the change. But let me try to add maybe 2 more here. One is just like using the formula we just have. Break even sales in unit. So given number 2, before you move on working on the problems, make sure you truly understand the information given by the income statement. And the current, the numbers I will mark include the current sales volume, and especially the per unit information. So $9 sales per unit price and the variable expense per unit is 6. And then the contribution margin is $3, right? And if I can probably add a percentage column. For getting the percentage, as we reviewed yesterday, the sales revenue should be the 100 is like your total, the pie, right? The whole pie, the piece of the pie, percentage. And then the variable expense is the 6 divided by 9 in this case. And let's get it as a percentage. So probably that's not an integer. So around 67%. And then the contribution margin percentage, you can use the 1, like the 100 minus the 67, or you can directly calculate by using the 3 divided by 9. We got 33%. Basically 2/3 of the revenue covers the variable expense, and 1/3 is as your contribution margin, right? So even I may not need the ratios, but this is another example for the 3 ways to use the contribution margin. And now after we have this information, so what's the break-even sales in units? I'm directly using the formula. So I'm looking for the total fixed expense, which they already given in the question in the table. 40,000. And I need the same amount of contribution margin to cover this fixed expense. And each unit can provide $3. So each unit sale give us $3 contribution margin, right? So each unit is $3. How many units will contribute to 40,000 contribution margin? So we divided by 3. So very straightforward. So how many units we sell? So each one making $3, and now that will be my sales, break-even sales in units. So divided by 3, and I'm just rounding to the whole total. Like this is approximate units. So break-even sales in units. Oh, if you're looking for the break-even sales in dollars, I'm sorry, yeah, in sales revenue, I can just quickly revise this to so change the bottom. Oh, sorry, I put one more here. It'll be like, it should be like 1 less 3. Okay, that's the 13. And this one you divide by the percentage of your contribution margin with the 33%. And then you will be getting the dollars directly. I'm also rounding to the integer. Okay, so 121, 212, okay, dollars around. So break even sales in units or in dollars. Then similarly, I think I will leave you to solve that. So target profit in units or in dollars. The only thing different, we add the desired. Okay, for example, I'm asking a target profit for 80,000. Yeah, this is not coming from the original problem. I just added by myself. So if I want to get a 80,000 profit, so what should it be my sales units or the sales revenue? Okay, by adding this 80,000 in the top of the formula, or like the top of the for the numerator of the equation. So that's the so that's two fundamental questions. So from here, what I'm looking for, how many questions I can ask from here? I can ask you to calculate the variable expense ratio, right? So you see I worked out it. And highlight all the contribution margin ratio. So if I know one of them, and then I can, ask a application of the two basic formulas, okay, for break even or target profit. And then the other concepts we might put a review here is the margin of safety or safety margin. And this one is the actual or your planned, okay, like, planning sales minus the break even. Okay, normally we use BE, break even. Okay, that's a lot in the short writing. Okay, break even sales. So in our case, if I use the sales volume will be current, we have 34,000, right, which I read from the question part, and minus the 13. Yeah, we have a quite a large safety margin, which is good. Okay, because it's like when you fly, the distance between your height of the airplane above the ground, right? The higher, I'm not really saying super higher, but the higher, so safety distance, safety height of your aircraft above the ground. So otherwise, so we call like cruiser height, so you can keep a safe distance before you're landing, right? So like descending gradually before you're landing. So same thing here, when you operate a business, I know my break even, but I want to get a much higher actual sales, so I will be much safer about my profit, okay, before, to looking for the benchmark. So you can quickly, we can get a unit. So 2/3 of the safety margin is like 6, 6, 7. And that's a unit, or even we can get a margin of safety percentage, because maybe you don't really have a feeling about how safe you are by giving the units only. But if I give you a percentage, use the safety margin divided by the current sales, the percentage is almost 60%, divided. Yes, 61 or around. So margin of safety around 61%, and this is actually a acceptable, not really super, but it's acceptable to good. Okay, like the threshold. So 60%, right? So like if you have the battery, right? So 100%, I have like 60%. So means I still have quite a distance, okay, before reaching out of the power, like before recharging needs. So acceptable to good. So a regular acceptable, I would say like because like from the industry experience, like practice, so 40 to 65%. So we normally call safe. And if you really have something below, like lower than 20%, okay, that's kind of is a red flag. Okay, be very cautious, because it's very easy and it will be very quickly. You can drop to the break even, okay, from the current sales, like the market situations. So margin of safety combined with your break even is a signal or ratio we can check for the safety, or like safety distance of your operational. Okay, it's not really human safety or health, is the business, the profit safety. Okay, like the case. So break even, target profit, and margin of safety. Let me